So hi, I'm Aarati Krishnan. I'm an editorial consultant with BusinessLine. There were four kinds of macro numbers that the markets were watching out for from the budget, and these numbers have all been of a kind to cheer the stock markets. So let's start with what they are. First, the thing that everybody looks for from the budget is the fiscal deficit number. So the first thing is the fiscal deficit for the current fiscal, and the next one is the fiscal deficit that is projected for the year ahead. So in terms of the fiscal deficit for FY22, the budget has actually given the number at 6.9%, which is only slightly higher than the target it had set at 6.8%. So it hasn't overshot the target by too much, but nor has it really curtailed expenditure. For the next year, FY23, there were a lot of expectations that they would really tighten the belt and go to 6% or even below 6%. But actually, Sitaraman has held the deficit number at 6.4%. What this shows is the government is continuing to prioritize spending over being very frugal, and it wants to stimulate growth because it sees that the economy is just about reviving from the pandemic. The second aspect that everybody looks for is the capital revenue mix. If you look at the government spending every year, actually, there's a lot of unproductive expenditure which goes on. The general belief is that a lot of the revenue part, which is the day-to-day expenses of the government, are actually unproductive. This is basically salaries and pensions to the staff, interest expenses incurred on loans, subsidies, giveaways, all these things. So the market always prefers it if the government spends more on acquiring assets or capital expenditure. So this year, the finance minister has really played to these expectations by saying that the capital outlay in the budget will be up by a massive 35% this year. So compared to FY22 revised estimates, FY23 estimates are 27% up in terms of capital expenditure, and this is one big factor that has cheered the stock market. We also heard a lot of announcements about public investments in road, Gati Shakti mission, etc., which all go towards this capital outlay. The third thing is, because there are 5 state elections coming up in the next few days, a lot of people were expecting the budget to be populist, but it has turned out to be anything but. Usually the first part of the budget speech is devoted a lot to farmers and welfare schemes, etc. But this time we saw the finance minister taking a direct dive into Gati Shakti mission, the national infrastructure pipeline, etc. Therefore, this shows that the government is quite serious about long-term infrastructure building and hasn't tried to really win brownie points by giving away subsidies or other kinds of sops to voters just to win the upcoming elections. The fourth aspect actually is that though capital expenditure has gone up quite a lot, the revenue expenditure has not gone up too much. So the overall spending of the government is going up only by 4.6% next year. Now, last year the government found a winning formula in actually under promising in its budget numbers and over delivering to those numbers. This script has been followed this time also. So the FM has actually budgeted for GDP growth for FY23 at 11.1%, which is quite conservative. And the tax revenues and other revenue projections are also very modest. Tax revenues, for example, are expected to grow only 9.5% in FY23. So the market sees all this as achievable. So overall on the macros, the budget had fairly good news to offer, and I must say it has bettered the expectations of markets and investors.